Hey everyone, and welcome back to Noob Selling Options. You ever see a stock just pop? It shoots up 20% overnight on some good news, and you get that instant punch of FOMO, that feeling in your gut that screams, I gotta get in on this right now. Well, today we're gonna talk about why that exact feeling can lead you straight into something called the valuation trap. Let's get into it.
And this quote, this is the thought process right here. It perfectly captures what's going on in people's heads. So many people watched a stock like Nvidia just go to the moon and make fortunes, and now they're just desperate not to miss the next one. So when a familiar, beaten down name suddenly has a shiny new comeback story, man, it feels like a sure thing.
And that's the billion-dollar question, isn't it? Is this surge the beginning of some legendary comeback you really can't afford to miss? Or is it a classic trap set perfectly for investors who let their emotions do the trading? Let's find out. Okay, so to really get why this is so dangerous, we have to look past the numbers for a second and dive into the psychology of what's driving this massive price surge. Because, trust me, in moments like these, the market isn't trading on fundamentals, it's trading on a story. It pretty much happens in 3 steps. First, you've got that powerful next Nvidia FOMO we just talked about. Then, step 2, the entire story, the whole narrative around the company shifts almost overnight. It goes from dying dinosaur to, oh, hey, they're a legitimate AI player now. The market treats this like flipping a switch. And finally, it's not just us retail folks. Big institutions who were shorting the stock are now getting squeezed and forced to buy, and all the trading algorithms see the momentum and pile in, creating this absolute tidal wave of buying. And here's the most important part of this whole thing. With that one giant price jump, the market has basically priced in years of perfect execution all at once. Any potential upside you thought you were getting from this big turnaround? Nope, it's already baked into the stock price. And what that means is there is absolutely zero room for error. And that leads us to the real hidden danger here. It's a concept you've got to know called being priced for perfection. It means that if you buy in today at this new high price, the company can't just do well. It has to be absolutely flawless for years just for you to maybe break even. Any tiny slip up, any missed deadline, and the stock can get completely crushed. Now, the technical name for this trap is multiple compression, and honestly, it's like the silent killer of returns. See, a stock's price is just its earnings per share times its PE ratio, which is just a fancy way of saying how much the market is willing to pay for $1 of its earnings. During these crazy hype cycles, that PE multiple gets stretched to insane levels. The trap is sprung when the hype dies down and that multiple shrinks back to normal, even while the company's earnings are actually growing like crazy. So let's really break down the mechanics here. This is exactly how a fantastic company, a company that's doing everything right, can end up giving you zero returns if you bought the hype at the very top. Okay, look at this. Let's say you buy the stock at $82. Right then, the actual earnings are still kind of low, so the PE multiple is through the roof, a massive 100x or even more. Now, let's fast forward 3 years. The company did it. They executed perfectly. Earnings are way, way up, but the hype is gone. The market is more rational, and now it gives the stock a more normal, though still pretty generous, PE multiple of, say, 60. Now look at the stock price. It's basically flat. All of that incredible earnings growth got completely canceled out by that shrinking multiple. All right, let's put some real hard numbers on this, because this is where it gets pretty sobering. We're going to run a super optimistic best-case scenario calculation. Let's assume the company just absolutely crushes it for the next 3 years. So here are our assumptions, and we're being really generous. First, we'll assume the company grows earnings by an incredible 30% every single year. Second, you buy the stock right now at today's peak price. And third, after 3 years of amazing performance, the market still gives it a really nice premium PE ratio of 60. So after all that success, what's your return? Your annualized return is just 6.5%. This right here illustrates the trap perfectly. The biggest risk isn't that the company's turnaround will fail. The biggest risk is that it will succeed and you'll still make no money because you paid way too much. You basically took on all the risk of a multi-year turnaround for pretty much zero reward. So, if buying the stock is a trap, what's the alternative? What do disciplined traders do in a situation like this? It's simple, actually. They don't buy the hype, they sell it. This really shows the two different mindsets. On one side, you have the retail hype buyer. They
They jump in, buying the stock, and taking on 100% of the risk that the company might not be perfect. On the other side, you have the disciplined option seller. They see this huge spike in hype and uncertainty, what we call high implied volatility, and they sell options to collect those fat, juicy premiums from people who are gambling on perfection.
So, what does that actually look like in practice? Well, instead of buying the stock at its absolute peak, a trader might sell a cash-secured put at a price that's much lower and safer. It's a strategy where you literally get paid to wait. If the stock drops to your target price, great, you get to buy it at a discount. If it stays high, you just keep the money you were paid up front. You let the hype die down and just wait for a real margin of safety to show up.
So I'll leave you with this question. The next time you see a stock gap up 20% and all the financial news channels are just screaming about a huge comeback story, what are you going to do? Are you going to be the one buying the stock at the top, or are you going to be the one selling the premium? Hey, if you found this breakdown of the valuation trap helpful, do me a favor and hit that like button. It really helps out the channel. And make sure you subscribe for more deep dives to help you navigate these super tricky markets. Thanks for watching, and I'll see you in the next one.